Hi everyone, welcome to the weekly market wrap-up. This week, we saw that the Monetary Policy Committee by the RBI delivered yet another rate hike of 35 basis points and took the repo rate now to 6.25. We believe that this rate hike was in line with market expectations and continued the withdrawal of accommodative stance to ensure that inflation will be in the target range going forward. While RBI's commentary appeared to be a tad hawkish, wanted to ensure inflation expectations are anchored, while action from central banks globally will be monitored closely. This move is to align with the acute global slowdown, market volatility, geopolitical shocks, soaring food and energy prices, supply side disruptions, and uncertainty around the inflationary environment. The latest rate hike by the RBI takes the total tally to 225 basis points, moving back to 2018 and 19 levels. Further, RBI retained CPI inflation forecast at 6.7% with risk evenly balanced and revised the real GDP growth rate to 6.8% from the earlier estimate of 7% for FY23, assuming crude oil will remain elevated at $100 per barrel. This particular chart talks about the key macro indicators after the MPC meet and before the MPC meet. So the repo rate stands at 6.25, the SDF, which is the standing deposit facility, stands at 6%, the MSF and bank rate stands at 6.5%, the cash reserve ratio stands at 4.5, real GDP at 6.8, CPI at 6.7, and the 10-year GSEC post the MPC was trading at a yield of 7.28%. The MPC highlighted that inflation will remain elevated and close to the upper tolerance level of 6%, and it is expected to moderate in the first half of FY24 due to geopolitical uncertainties, supply chain disruptions, and elevated food and energy prices. Real GDP for the quarter 2 of FY23 grew by 6.3%, led by robust growth in private consumption and investment demand. India is expected to be one of the fastest growing economies in the world, irrespective of the drop that we saw from 13.5 in quarter 1 to 6.3 in quarter 2. Bank credit demand stands robust at 17.2%. This shows that the credit demand is led by the retail loans and the working capital demand sector in general. RBI remains in the absorption mode. However, RBI conducted LAF operations and is ready for LAF operations as and when liquidity is required in the system. The total flow of resources expanded by 14.7 lakh crore during FY23, backed by strong support from banks and NBFCs to the commercial sector, showing robust business growth. The manufacturing and the service PMI numbers for India stands at a record high levels, and India is among the highest among the peer countries in the world. The manufacturing PMI stands at 55.7, whereas the service PMI number stands at 56.4, showing strong economic sentiment. The FDI flows have remained robust, and again in the month of November we saw huge equity infusion coming in the equity markets. India's forex reserves remain comfortable at $561.2 billion, covering approximately 9 months of projected imports. The external debt to GDP ratio for India remains the lowest among the emerging economies, displaying comfortable financial position. Among the other measures, RBI announced that the Bharat Bill payment system has been extended to include various categories of payments for faster access to funds. This particular chart talks about the key policy rates for RBI, the repo rate, the reverse repo rate, the cash reserve ratio, and the standing deposit facility. The headline CPI inflation stands at 6.77%, whereas the upper range and the lower range is closer to 2 to 6%. So 4% is the target. The lower range is 2% and the upper range is 6%. The outlook for India's real GDP So this chart talks about where India's real GDP has been for the last 10 years. So it has stood closer to as an average of 6.84%. This shows that India is on track to achieve 6.8% GDP for FY23 as well. India's expected inclusion in the global bond index will ensure that we have higher FPI investments coming in the debt market, which will deepen the fixed income market. We believe that India continues to remain resilient on the back of strong GST collections, real GDP growth rate, PMI numbers, adequate forex reserves to cover imports, the low external debt to GDP ratio, among many other strong macro indicators. RBI in this MPC meet has maintained the hawkish stance, while we believe that the tide will turn once inflation starts cooling off. RBI has been taking proactive steps to protect the economy from rising inflationary pressures, to limit the downside of the rupee, improving flows into the economy, thus making sure that there is long-term growth rate for the country. Thank you so much.